right, guys, a community request video here, 2 stocks. We're going to get into them. We're going to go over their high-level metrics. We're going to cover some bull and bear cases from our community members who requested this. We're going to cover the 8 pillars, analyst estimates, and then we're going to finish it off with our stock analyzer tool, which will allow us to make our assumptions about the future, and it'll tell us what price to pay for the company based on those assumptions, not including the balance sheet. But we're going to share some of the community members' stock analyzer tools as well. So, first company, CVS. CVS Health Corp. Now, it's a $92 billion company for market cap. If you wanted to buy every share outstanding, you'd spend $92 billion. And the enterprise value is $250 billion. That difference is all debt, basically. That's a lot, but it's CVS. They have all these leases. That's the big reason for that big enterprise value difference here. When a company has a lot of leases, they get added in there as debt. Now, here's what's attractive about the company. Their 5-year average net income is 6.2, and their 5-year free cash flow is 13.5. Big difference here. But the great thing is their free cash flow is higher than their net income, which I love. Now look at this. Last year's free cash flow was $17.7 billion, and their net income was $2.9. Why such a difference? There was probably some sort of write-off that occurred that did not affect cash flow, but affected net income. Because write-offs might be based on, they made an investment 5 years ago. Remember, when they make an investment, it doesn't go against net income. But if the investment goes poorly and they mark it down, it does go against net income, but not in the year that it occurred. So it occurs, it's written off in the year they realize the loss. That's how there's a difference between free cash flow and net income at times, okay? Now, profit margin is slipping. It was 2.2% over the last 5 years on average, 0.9% last year. But again, because of this big write-off. Guys, big dividend, 3.3%. Pays $3 billion a year. They can easily afford that based on their cash flow. Look at that cash flow, $13.5 billion over the last 5 years. They only paid out $3 billion. All right, so CVS is great. They have great locations. They're a great company. The question you have to ask yourself is this dividend safe? Seems pretty safe. This margin's pretty low, but that seems to be the industry they're in. Okay, that might be okay. One thing I don't like, very bad return on invested capital, 6.2%. But with that said, I'm glad they're buying back. I'm glad they're paying a dividend. But I actually wish they would buy back shares. Because look at this. Their price to free cash flow is single digits. So remember, their PE ratio was high. Their price to free cash flow, because the cash flow is so much higher than earnings, is very, very, very low. Now, guys, in our community who requested this, one thing I ask is, how the heck is their free cash flow so much better than their earnings? I mean, look at the cash from operations here. 6.3, 8, 9.6, 11.6, 7.7, 10.9, 16, 14, 18.5, 20. I mean, just huge amounts of cash from operations just growing. But their net income, the top here, it's not bad, but it's nowhere close to their free cash flow. So that's the first question I'm going to ask you guys in our community to talk about here. All right, let's check out the 8 pillars in the company. I'm actually surprised by this. And remember, guys, in our community, you can customize your pillars up to 12 different pillars. But net income growth is down, but free cash flow is up. So I'm not really worried about this net income X. ROIC is low. I don't like that. Increase their shares outstanding. That could have been from an acquisition, though. That could be the case on the acquisition. Sometimes when companies make acquisitions, they issue shares. But with this low multiple of free cash flow, why are you giving out shares when the stock is cheap? I don't remember what it was when they made the acquisition, but that'd be part of it. And I'm not worried about debt here. So really the only ones I'm concerned about are these 2. That's not bad. And their PE is still only 15 here. So I'm looking at this going, okay, if I can understand their free cash flow and why it's so different, this is a pretty interesting company. Now let's go to our community and see where they stand. Right here, Ali writes some of the bull and bear cases. Revenue and cash flow have been growing since 2003. Here's what he shows. Yeah, this is beautiful. I mean, it's just been growing every year since 2003, essentially. Shareholder equity has been increasing. Revenue from CVS Premium has been growing faster than revenue from products. It could possibly compete against Amazon Pharmacy. It offers free shipping on prescriptions and 24/7 access to pharmacists. Guys, last night, one of the dogs peed on one of our rugs. And my fiance had said, oh, I read something about shaving cream works. She's like, Paul, do you have any creamy shaving cream. I said, no, I don't. So what I do? I got in the car, went 3 minutes down the road, bought shaving cream from CVS, came back home. Even if Amazon had 1 hour delivery, it was better for me to go to the local CVS. I'm not saying that CVS is never going to be replaced and all that stuff, but there is still a value to me being able to jump in the car, go 3 minutes down the road, pick something up, and come back home. CVS in 2022 has the largest pharmacy retail market share of 25% compared to Walgreens at 15%, Cigna at 11%, and United Health at 6.9%. Great inventory management. Figure 5. Boy, this guy's great. Holy cow, Ollie, you're the man. Days of sales of inventory. Look at this. Since 2003, their inventory management, they went from an average of 75 days of sales and inventory to now 25. They've decreased their inventory by 66%. That's awesome. Good job. That is awesome. All right, some risks. Gross margin has been dropping. That is true. Look at the gross margin here. New acquisition, Signify and Oak Street Health might lower the operating margin. Okay. Partnering with Codervis might lower profit margin, and loss of Blue Shield CA might trigger further contract loss, or CVS has to lower its price, thinner margin. Okay. So those are issues. For sure, but I think their bulls here are way better. I'm gonna give him a thumbs up. Good stuff. Okay, so what's the price to pay? Let's see what somebody put in CVS here on their stock analyzer tool. All right, so this is D-Money, one of our users. Here are the assumptions he's put in. 3, 5, and 7% revenue growth, profit margins of 2, 2.5, and 3, free cash flow margin of 4, 4.5, and 5, PE of 16, 17, and 18, same with free cash flow, and a desired return of 12.5, 13.5, and 14.5% return. I think these are very reasonable. And remember, these desired returns include the dividends. Now, I probably wouldn't have been as high on my desired return, but there is, I can understand this though. So 3, 5, and 7 seems a little aggressive on revenue growth. Let's see what the analysts are saying about the revenue growth for CVS. Yeah, I probably would have done a little bit lower, but I understand this. And his values, guys, here at the bottom, he has a low of 60 to 130, a high of 123 to 206, and a middle of 90 to 170. I don't disagree with them. Let me see what last time I did it. What was the last time I did it? CVS. I did it recently, I think, in a video. August 21st. All right. And I came up with these numbers. Now, from a free cash flow perspective, it's worth a ton more. So I got to really understand how that free cash flow is so different than earnings. Because look at how much different this free cash flow versus multiple of earnings is. But some huge potential here. Huge potential. Why do I have it on my watch list at 60? Oh, because I was like, listen, if I buy it at 60, it doesn't matter if the free cash flow and earnings never. I just don't know why the earnings and free cash flow have never merged together. I got to understand that part. All right, guys, next company. CVS's major competitor, Walgreens. Now, I don't own Walgreens, but I used to be big on it, and I sold them because I started to get a little worried about their return on invested capital being so terrible. That's when I sold it. I don't know, maybe, I don't remember when I sold it, but it was probably like 9 months or a year ago. $18 billion market cap versus CVS, which was a $92 billion market cap. Dividend of 9%. See, but look at that. I think CVS is the better play here. $1.65 billion of their $5.3 billion free cash flow. Low profit margin was negative recently. 5-year average is 1.5. Gross profit of 20%. CVS's gross profit of 16%. So actually lower. Interesting for CVS. Let's see what analyst estimates are saying. Better growth potential in revenue. I'm just going to skip right to the community and see what they said about Walgreens. Wicked Willie, bull cases. Divested its stake in AmerisourceBergen Corp for proceeds of $1.6 billion. Okay. Held 15% of the U.S. pharmacy share market, behind CVS. Bear case. Rosalind Brewer steps down as CEO and board member, and Geiner Graham takes over while replacement is found. Not only is the U.S. healthcare segment worsening, but the business has been hindered by a $44 million fine due to Theranos claims. Ooh, Theranos. Theranos is the Elizabeth Holmes issue. So they were involved with them, really going investing and backing them up. Let's see here. I think the argument these stocks are trading at good value. Let's see what D-Money says about WBA. Okay. So I'm going to go right here to the stock analyzer tool. Now, guys, one thing I want to say is you've seen us use the community. You've seen us use the stock analyzer tool. There's so many other tools here. And of course, you're probably wondering what it's all about. So here it is. Now, I'm not asking you to make a decision yes or no today. But what I want you to do is to make an informed decision. And I cannot stress that enough. If you are making an informed decision, you got to be on the inside. You can't be on the outside trying to make an informed decision. Just like when you want to buy a car or buy a home, you got to go through the house, you got to test drive the car. No different here. But what I'm offering you here, instead of a 15-minute test drive, I'm offering you a 7-day full access, free trial test drive. Full access to everything, community, tools, everything. All you got to do is go to everythingmoney.com. In 7 days, if you realize the value and you see how it can change the way you can think for decades to come, sign up. And if not, no offense taken, no hard feelings, move on. But the thing I'm asking you to do is make an informed decision by joining the community fully for free 7-day access. I'm so confident you'll find value in it that I'm not even asking for a credit card up front. Just your email. It's all you need. So go to everythingmoney.com, sign up for the 7-day full access free trial. Thanks very much. Now let's pull up my WBA, most recent, back on August 21st. So I did 2%, 4%, and 6% revenue growth. I did 1.75, 2.25, and 2.75% profit margin. They have a higher free cash flow than profit margin. I think the numbers in the 5 and 10 years look way better than the 1-year numbers. So the question is it temporary, et cetera? So 2.5, 3, 3.5. I did a very low PE, 10, 12.5, 15. Same with price of free cash flow. I did a higher return needed, 12, 14, 16. Guys, it makes sense here. Boy, look at this. A low price of 26 to 38, high price of 51 to 66, middle price of 38 to 50. Man, and I think I sold it like 30, low 30s, but I'd been buying it since the high 30s. Man, this just looks, boy, it's a tough one. Guys, talk to me in the community. Join the software, everythingmoney.com for free for 7 days, and please talk to me about these two companies. I'd love to hear it. Thanks very much.